Hello everyone, I'm Yali Jiang. Right now, the silver market is experiencing something we haven't seen in years, a fundamental shift in how the metal is being accumulated, stored, and traded. While Western markets debate whether Comex will default, Chinese entities are quietly positioning themselves to control a larger share of global silver flows. This isn't about conspiracy. It's about strategy, and the evidence is visible in the data. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. The structural changes happening in silver aren't making headlines yet, but they're reshaping the market in ways that will matter for years. Let me walk you through the numbers. Silver spot prices have moved from around $18 per ounce in late 2023 to above $30 by early 2025. That's a gain of more than 60% in just over a year. But price alone doesn't tell the story. What matters is the behavior underneath that move. Volume on the Shanghai Gold Exchange has increased substantially during this period. Chinese investors and institutions have been buying physical silver consistently, not speculating on futures, but taking delivery. That's a critical distinction. Now look at what's happening with ETF flows. In North America and Europe, silver ETFs have seen mixed activity. Some funds report outflows as retail investors rotate into other assets. But in Asia, particularly in funds accessible to Chinese investors, inflows have been steady. The pattern suggests a divergence in sentiment. Western markets treat silver as a speculative commodity. Eastern markets are treating it as a strategic asset. Let's talk about industrial demand. Silver is not just a monetary metal. It's essential for solar panels, electronics, automotive systems, and emerging technologies. China is the world's largest producer of solar panels. The country installed more solar capacity in 2024 than the rest of the world combined. Every panel requires silver paste for conductivity. As China expands domestic renewable energy and exports solar technology globally, its need for silver is structural, not cyclical. Here's where it becomes important. Chinese demand is not speculative. It's tied to national industrial policy. The government has made it clear that energy independence and technological dominance are priorities. Silver is a necessary input for both. That creates baseline demand that doesn't disappear when prices rise. It creates incentive to secure supply at almost any cost. Now notice what's happening on the supply side. Global mine production of silver has been relatively flat for the past 5 years. Major silver-producing countries like Mexico, Peru, and China itself have not significantly increased output. Exploration budgets remain low because silver is often a byproduct of base metal mining, and those projects are capital-intensive with long lead times. Recycling helps, but it can't close the gap between consumption and new supply. The deficit is real. But here's where the tension builds. Comex warehouse inventories have declined sharply over the past 18 months. Registered silver, the portion available for delivery against futures contracts, is at multi-year lows. Eligible silver, which could be converted to registered, is also down. These inventories represent the buffer that allows the futures market to function smoothly. When that buffer shrinks, delivery risk increases. Does that mean Comex will default? No. Exchanges have mechanisms to manage delivery squeezes. They can raise margin requirements. They can implement position limits. They can declare force majeure in extreme cases. The system is designed to prevent outright default, but managing a tight market comes with consequences. It creates volatility. It discourages speculators. It shifts confidence. Look closely at this trend. Chinese institutions are not trying to break Comex. They're doing something more strategic. They're using Western market weakness to accumulate physical metal at favorable prices, then moving that metal into domestic vaults where it stays. This pattern has appeared before in other commodities: copper, nickel, rare earths. The playbook is consistent. Buy during Western selling, store domestically, control supply when demand tightens. Now let's connect this to currency. The dollar has been under pressure as federal debt grows and global central banks diversify reserves. China holds more than $3 trillion in foreign exchange reserves, much of it in dollar-denominated assets. That's both a strength and a vulnerability. Diversification into hard assets like gold and silver reduces dollar exposure without triggering market panic. It's quiet, incremental, and deliberate. Silver benefits from this dynamic because it's cheaper than gold on a per-ounce basis. It's easier to accumulate in size, and it has industrial utility that gold lacks. For a country trying to secure supply chains and reduce reliance on Western financial systems, silver makes sense. It's a hedge, a strategic material, and a store of value all at once. Here's the gold-silver ratio. Historically, this ratio has fluctuated between 50 and 80. When it's above 80, silver is cheap relative to gold. When it's below 50, silver is expensive. Right now, the ratio is in the mid-70s, trending lower. That suggests silver is strengthening relative to gold. It's not just price momentum. It's a shift in perception. Investors are starting to see silver not just as gold's cheaper cousin, but as an asset with independent demand drivers. Interest rates matter here too. The Federal Reserve cut rates in late 2024 and signaled more cuts could come if inflation stabilizes. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. They also weaken the dollar, which makes dollar-denominated commodities more attractive to foreign buyers. China, with its massive dollar reserves, benefits directly from this environment. Every rate cut makes it cheaper in real terms for Chinese buyers to convert dollars into physical silver. Let me walk you through what this means for market structure. Comex is a paper market. Most contracts are settled in cash, not metal. That works fine when confidence is high and inventories are ample. But when physical demand rises and inventories fall, the paper market becomes disconnected from the physical market. Premiums appear, delivery delays happen, trust erodes. Shanghai operates differently. It's a physical delivery market. Contracts are backed by metal in approved vaults. There's no leveraged paper structure sitting on top. That makes it less liquid, but more trustworthy for buyers who want actual silver. As Western markets become more volatile and less reliable for delivery, Eastern markets become more attractive. That shift is already happening. This pattern has appeared before. In 2011, silver spiked to nearly $50 amid speculation about supply shortages. Comex raised margins 5 times in 2 weeks to cool the market. Prices collapsed. Speculators were wiped out, but the underlying demand didn't disappear. It just moved. Asian buyers stepped in and accumulated during the correction. The same dynamic is playing out now, but with more sophistication and institutional backing. Now notice what changed. In 2011, Chinese silver accumulation was fragmented, mostly private buyers and small firms. Today it's coordinated. State-owned enterprises, sovereign wealth-linked funds, and government-backed trading companies are involved. That's not speculation, that's policy. When accumulation becomes policy, the timeline extends, the strategy becomes patient, the end game becomes clear. But here's where it becomes important. If Comex remains structurally tight and Shanghai continues to absorb physical supply, a two-tier market develops. One price for paper, one price for metal. Arbitrage opportunities will exist, but they require the ability to move large quantities of physical silver across borders, clear customs, and navigate capital controls. That's not something retail investors can do. It's something sovereign entities and large institutions can do. What does this tell us? It tells us the silver market is fragmenting along geographic and structural lines. It tells us confidence in Western paper markets is weakening. It tells us Eastern physical markets are gaining influence. And it tells us that the country with the most industrial demand, the largest dollar reserves, and the clearest strategic interest in securing hard assets is positioning itself to control pricing power. Let's talk about what this suggests for inflation. Silver has historically been sensitive to inflation expectations. When investors fear currency debasement, they buy precious metals. But silver also has industrial demand that responds to real economic growth. That dual nature makes it more volatile than gold, but also more responsive to fundamental shifts. Right now, both factors are aligned. Inflation concerns persist despite rate cuts, and industrial demand is rising due to the energy transition. That combination is rare. What does this suggest about currency confidence? The fact that central banks and sovereign funds are diversifying into hard assets signals concern about fiat currency stability. It's not panic, it's prudence. But when the world's second largest economy is systematically moving wealth out of dollars and into tangible assets, the message is clear. Trust in the existing monetary system is conditional, not absolute. What does this suggest about investment psychology? For decades, Western investors have treated commodities as a sideshow, something you rotate into during crises and exit during recoveries. That mindset is changing. The recognition that supply chains matter, that energy security matters, that resource independence matters, is reshaping how institutions think about asset allocation. Silver sits at the intersection of those concerns. So here's what we're looking at. Comex won't default because exchanges have tools to prevent that. But tightness in the physical market will persist because supply is constrained and industrial demand is structural. Chinese entities will continue to accumulate because silver serves multiple strategic objectives. Western investors will eventually notice the divergence between paper prices and physical availability. When they do, premiums will widen and confidence in futures markets will erode further. This isn't a prediction of collapse. It's a recognition of transition. The silver market is moving from a speculator-driven, paper-based system to a bifurcated structure where physical flows matter more than futures positioning. China is ahead of that transition. Western markets are still catching up. Long-term implications for investors are significant. If you own paper silver through ETFs or unallocated accounts, understand the difference between claim and possession. If you're considering physical silver, recognize that premiums may rise as demand for deliverable metal increases. If you're watching Comex inventories, treat them as a leading indicator of market stress, not a lagging one. The silver market is changing. The change is structural, not temporary. And the country best positioned to benefit from that change is the one moving quietly, consistently, and strategically, while others debate whether the system will break. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize.